In this Advisor You Can Talk To podcast, Chief Investment Officer Jim Lowell and I will discuss the current coronavirus crisis and its impact on the economy and the markets. Hello, this is Dan Weiner, and I'm Chairman at Advisor Investments.
And I'm Jim Lowell, Chief Investment Officer at Advisor Investments.
And we're here with another Advisor You Can Talk To podcast. It's Wednesday, it's April 1st. Jim, it's an April Fool's Day.
I like it, Dan.
I don't know what we're going to do with that because I think we want to address some more serious topics. But in fact, given that it's April Fool's Day, how do you feel about this new bull market that Dow Jones introduced the other day? We had a 3-day rally. The stock market went up. The Dow, anyway, went up more than 20%. And all of a sudden, the Wall Street Journal, Dow Jones, is calling it a new bull market. Do you buy it?
No, I don't buy it. I think that we have a long, volatile way to go, but hopefully in a short amount of months to get from where we are today to where inevitably we will be, which will be in a recovery trajectory, rather than what I think is still a market, an economy that's clearly prone to the ever-changing medical data as much as it is prone to the economic earnings and interest rate data. So I think while it was certainly great to see the rally, and while we say time in the markets, not market timing, as a discipline, longstanding of ours, to capture the sense that you really never want to be out of a market totally because you will miss such significant upsides as we were able to witness just last week. Nevertheless, there's still likely to be consistently more downward than upward pressure on the markets in the days and weeks ahead.
Yeah, let's talk about that for a minute. So last week, we got maybe the first and I would say only piece of economic data that really reflects what's going on with this pandemic that has hit globally and now hit in the U.S. We saw that new unemployment claims number. This is people who are filing for unemployment for the first time, jump from the 200,000 level to the 3.3 million level. And yet the stock market was up 6% that day.
So first, a staggering number, likely to get significantly more staggering as we enter the really difficult weeks and potential months as we sort out virus fact from market and investor emotion.
Right, we're
And
going to get another number tomorrow. I mean, it's
we
Thursday
are,
morning.
and it's going to be, I've seen estimates as high as a third of the U.S. workforce being unemployed, and we'd like to say, obviously, that we focus on jobs as a litmus test of the health of our economy because we are a consumer-driven economy, meaning the better the employment numbers are, typically the healthier our economy is, and vice versa. But that said, while the numbers are going to be just off the charts bleak, Depression era level numbers, we think it's better to call it a suspension rather than an unemployment theme because eventually these jobs, many of them, will likely be built back in as the demand recovery gets underway. We don't know when that will be, but we don't think it's a question of if. And I don't know about you, Dan, but I haven't yet seen an estimate of how many jobs and at what rate they'll return once we really take a turn for the better in terms of this current crisis. But we definitely know that we're analyzing, researching, separating the kinds of employment data that we think we will see from what we absolutely know will be a chorus of very bad news over the next weeks, potentially months.
Well, I think what you're getting at here is this question about whether we have a V-shaped recovery in the economy and a V-shaped recovery in the stock market, right? I mean, we're talking about a situation, and it's not surprising that we don't really have an answer for this yet, because, as I said, the single piece of economic data we've seen was last week's unemployment claims number. And yes, the first quarter earnings conference calls with corporate executives are going to start in the next week or two. And really, it's not going to be a question of what the earnings were in the just ended quarter. It's going to be a question of what are these executives, what are these leaders of major U.S. corporations seeing out in the world? How is their demand changing? We know for a fact that if you're an airline, a cruise ship operator, a, a restaurateur, your demand for your products and services is virtually has disappeared. But on the other hand, there are going to be companies that are going to be winners in this, and that's what we're hoping to hear. I don't know if you've heard any rumors. We've certainly been talking to our fund managers, the people that we invest alongside with, about what they're hearing and what they're seeing. And I don't know about you, I've gotten some comfort from them that the companies they've selected are really going to be the winners in this overall.
Well, I think that's a great point, Dan. They're taking this bear market opportunity to upgrade the quality of the names in their portfolio, to add to some of their best ideas at deeply discounted prices. We know that if it's the international managers that we invest in and respect, they are not in the countries where the crisis is unfolding so much as they're standing on the borders with binoculars, looking in at opportunities that they know will be made manifest by this kind of crisis. And the overall point, maybe there, is that we have said for now decades that we buy the manager, not the fund. We're obviously not just believers in active management. It is at the core of our investment discipline and philosophy. And as we talk to managers, I have not heard them come to a consensus on what they think guidance will or won't be, except to say that for the most part, guidance coming out of this earnings round, if it is in fact offered, will be basically little more than conjecture. But that doesn't mean that there aren't great companies. And as you said, companies absolutely capable of growing market share in this crisis, clearly at the expense of some other companies who will
Sure,
not be.
there's going to be a shakeout.
Yeah.
What I've been reading about, for instance, American Airlines, they're in a precarious financial situation. But if an American Airlines, and I'm not saying they will, but if they were going to go out of business, a Delta or a United or US, one of the other big airlines could come in, grab their roots. That's the strong survive here, right? This
No
is the
question about
law
it.
of the jungle.
No question about it. And speaking of law of the jungle, what we know about that law is that not only the fittest survive, but they tend to thrive when they come out the other side of a crisis. And so we know that our managers, certainly our research team, we are looking at areas not just domestically but around the globe where we think we'll see durable strength, and strength that will be able to capitalize on what we think will be an inevitable rebound. Although we don't want to sugarcoat it, we think that we really could be seeing some volatile times, not just as we head into the summer months, but don't forget, without a vaccine likely to be delivered until 2021, we've got to go through another bout of this virus as we head towards the end of this year. So we're in for some volatile times, but of course we run our portfolios with measurable defense, more measurable now than I think at really any time prior. We've got good buffers in place, bond buffers, even some cash reserves, dry powder for being able to add to better opportunities when we think we see a little bit more clearly what the long-term prospect of coming out of this near-term crisis is.
Well, let's
But
talk about, you mentioned bonds.
yeah,
The last couple of weeks, I don't believe I've used the word dislocation so many times uh, since throwing my leg out one time. I mean, there were these tremendous dislocations in the bond market, and it felt a little bit like 2008 when the bond market seized up. But this time, it wasn't so much that it was seizing up; it was as if the plumbing had gotten clogged, and there were more. It's always fascinating to me that when there are more sellers, say, than buyers, there's all sorts of trouble in the bond market. But when there's more buyers than sellers, everything seems to go so smoothly. I was a little confused by this. It does seem to have worked its magic out a bit, or the magic has come back and they've worked out some of the kinks. But it was pretty, I hate to say it, dislocating for a couple of weeks there.
No question, it was unnerving. Although I would say past bear markets have exhibited at least a relatively similar pattern, where at some point everything gets thrown out with the bathwater, especially the greatest sources of liquidity, and that, of course, is a time where active managers and managers of active managers like us hopefully earn our keep and don't run away from the opportunities that those dislocations create.
It's funny. I have been talking to a couple of bond managers the last week, and this was, I think, a market experience where the ETF market, the exchange traded fund market, really fell on its face. Where the participants who create, without getting into the details of this, the participants who create the ETF shares really were not stepping up, and the market, uh, those who were proponents of ETFs said that price discovery had risen in importance. But I think that what was going on there was that the scaredy cats had basically left the room and nobody was willing to make a market for these things. So I felt like our good old tried and true open end mutual funds that price once a day were a lot more secure and safe for investors than these newfangled shiny toys called ETFs.
I might not go that far, but I would certainly say that I think the ETF industry as a whole saw a structural deficit in the way its instruments were trading, and I know that they have been studying that painful lesson rapidly and hopefully well. We'll know when the next downturn comes. Uh, Nevertheless, as you say, mutual funds did not necessarily suffer the same kind of misfortune on the bond side of the fence. And speaking of maybe not misfortune, Dan, but let's talk about something that's really held up well in this crisis-driven market, and that's the healthcare sector, long and overweight inside of our portfolios.
Yeah, well, we probably are putting our clients to sleep talking about this so often, but healthcare has always been an overweight in our portfolios, and there are periods when it really shows its defensive capabilities. I mean, one of the things about the healthcare sector is that it is very, very diverse. Right? We're talking about pharmaceutical companies, we're talking about biotech companies, we're talking about medical supply companies, and we're talking about medical service companies. So, X the pandemic, we have always been big fans of this industry because it is what 15, 16, 17% of GDP in the US alone. It's an industry that is global in nature. There are fantastic companies both overseas and here at home to invest in. The mapping of the genome 10 years ago or so is finally beginning to bear fruit. Um, we could go on and on about why we think healthcare is a great industry, but yes, in these trying times, it has held up better, and you and I both are big believers that active managers are the best way to gain access to this sector.
And to the whole market. This is a market where selectivity, stock picking, skill sets, the things that we really, and our research team, led by Jeff DeMaso, spend their days poring over, come to the fore. This is not a market where you want to own the whole market. This is a market where, to get back to your earlier comments, you want to really be able to sort out the fittest companies that have the highest probability, not just of surviving, but of thriving.
Right.
So, Dan, I guess as we're coming to the end of this conversation, can I ask you a non-investment question? Um,
Sure. Why
you know,
not?
I think I think a lot of our listeners would like to know, what we're doing to keep ourselves sane outside of all of the investment research material we're pouring over. So, what non-investment themed book or movie do you recommend for all of us who need some real downtime?
Oh, you're playing into my hand here. Am I allowed to plug my daughter's book, Uncanny Valley?
I hope you do.
Okay, well, I will plug my daughter's Anna Wiener's book, Uncanny Valley, which hit the New York Times bestseller list. And but I noticed you said non-investment themed. Believe it or not, right now I am reading Huckleberry Finn, escapism reading about escapism down the Mississippi River. My wife read it on vacation and said it was a must read just to change course in the course of our lives. So I figured I'd do that. And then there are some business books that I've read over the last year or so that I thought were just fantastic. The book about Theranos, Bad Blood, the Mike Isaac book about Uber, Super Pumped, and then I recently read Dark Towers, which is a book about Deutsche Bank. So um, I recommend all of them. But what are you reading? You're a poet.
I always recommend any sort of selection or collection of Seamus Heaney's poems, in good times or bad. I think one of my top 10 films, let's see, neither artistic nor thought provoking, would be an homage to spaghetti westerns and kung fu flicks called Big Trouble in Little China. Uh, a book that has given me some historical context for today's crisis with specific regard to U.S. China relations over the past 100 years. And it's a very readable book. It's called The Imperial Cruise by James Bradley. And ultimately, I think between the two of us, we've just created a great book list for all of those who are listening.
Well, I appreciate your time, Jim, and I hope everyone has enjoyed these podcasts. We are going to try to keep these going on a regular basis now, particularly during this stressful time. This has been Dan Weiner
And Jim Lowell.
from Advisor Investments, and I want to thank you for listening to the Advisor You Can Talk To podcast. If you enjoyed this conversation, and I hope you did, please subscribe and review our show. You can check us out at advisorinvestments.com/podcasts. Your feedback really is always welcome. I really mean that. If you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. And thanks for listening.